Hey dividend investors, ever since I had my friend Greg here on the channel, I've been in search of some higher yielding dividend stocks within my own portfolio. Of course, I've been doing high yield so far within the realm of my premium core, blue chip, if you will, dividend stocks. In my last video, which I will link to in the pinned comment below, I covered 22 different dividend stocks and I honed in on 10 of those dividend stocks that I like right now in terms of higher dividend yield. In fact, I just bought some more Altria, for example, and I already shared that over on Patreon, which I will also link to in the pinned comment below. After filming my video last time, I realized, hey, I forgot one of the higher yielder stocks in my portfolio that I want to cover. This is a stock I have not covered for quite some time. I'm talking about Unilever, the makers of the Dove Sensitive Soap. Of course, I'm so fresh and so clean, so I've got to use the sensitive skin soap from Dove. Unilever is a European company, and with analyzing a European company comes some challenges, some nuances. And I'm looking forward to going through this investment today because I plan on buying more and it's offering a solid starting dividend yield over 3%. The company has faced some challenges, particularly on pressures around margins. This has helped keep the stock price down, in which I am looking at as a long-term buying opportunity. Merry Christmas, by the way, everyone. This is the 26th of December. I took the 25th off to celebrate Christmas, but I'm back at it today. If you appreciate these videos, please don't forget to click that like button. It means the world to me. I'm taking time away from the family, away from the holidays, because I love all of you. I love dividend investing. I know how important these videos are, and I want to motivate the world out there to look at dividend stock investing as 2023 approaches. Get ready, everyone, for a really exciting dividend stock investing video. Welcome to PPC Ian. This is dividend stock investing for everyone. All right, everyone. So I want to start out with a slide from Unilever's recent Q3 earnings report. Check it out on the screen in front of you right now. This slide shows just how strong the company is doing right now in terms of sales. Now, worth noting, being a European company, the numbers here are reported in euros, and the word turnover, that actually means the same as revenue in the US, or sales. And so you can see that turnover is a really strong, and it's growing year over year at a rapid pace. It even says here in the third quarter highlights that underlying sales growth, it accelerated to 10.6%. And they actually they increased their sales guidance for the full year. They're talking about price growth stepped up to 12.5% for the quarter, but volumes declined. I think this is an important point. Sales are really strong at Unilever right now, and they're having strong sales or strong turnover, but this is at the expense of volume. Volumes are shrinking slightly. You're going to see this on a future slide, but it's actually shrinking across the board in all of their geographies. But the sales growth is so strong because of their pricing power. And this is why I love investing in dividend stocks, because even in rough times like the overall economy is facing right now, they're able to increase prices on these everyday products. Everyone needs some soap, for example, to take a shower. Everyone needs the types of products that Unilever sells, and that's what gives them pricing power. But at a certain point, will there be an inflection where the price increases are not enough really to compensate for volume losses? Quite possibly. We'll see how far they can push this thing, but so far the pricing increases are working. So as you can see on the screen in front of you right now, I want to go through just a few more things on this particular slide. They talk about some billion plus euro brands. accounting for more than 50% of the turnover. And I want to just highlight some of the brands here. You can see like OMO, Hellmann's, Rexona, Magnum, and Lux. I'm not as familiar with these brands, being a United States investor, US-based, US citizen investor, but I'm sure some of you tuning in from overseas, from in Europe, might understand some of these brands better, and from maybe Latin America as well, and some of the APAC markets as well. They are refining their business quite a bit. I know just going through their Q3 report, they're trying to reshape their business and really focus on their core brands. They're trying to divest some of their less important brands, and they're trying to re-architect the business around these categories of beauty and well-being, personal care, home care, nutrition, and ice cream. And so that's what this company is all about right now. And they are buying back shares as well. And so it's interesting, they're doing 750 million euro buyback as well. So in a nutshell, that's what's going on at the company right now. A lot of it positive news. The main thing I took away from that slide in terms of negative news is the volumes shrinking. But it gets worse. I want to keep going. Nothing is on sale without some level of risk. And so as a dividend investor, one of the things I always try to do, like when I was buying Procter & Gamble back a few years ago when they were facing some challenges, now they have overcome those challenges and that stock has gone through the roof. I'm going to do a comparable to P&G later today. But Unilever, I almost feel like they're having their Procter & Gamble-like scenario right now. And so the company is growing. Top line is good, but they're having troubles with margins. I think they're having troubles probably just with the pricing inputs, the cost of inputs to produce their products going through the roof. But I also feel Procter & Gamble is doing just fine right now. They have overcome the challenges they faced a few years ago. I think Unilever is having their P&G-like moment. And so I'm placing the conscious bet here. I'm allocating risk in my portfolio towards this stock with the belief that looking 5+ years out, they will be thriving just as Procter & Gamble had overcome the challenges that they were facing. So anyway, let's keep going though. As you can see on the screen in front of you right now, I have the second slide for today, and this one is just their consolidated income statement. Now keep in mind that this one is not from the Q3 report. I took this one from the first half of 2022 report because in the Q3 report, I could not find the consolidated income statement. But I want to use this slide that summarizes the first half of 2022 to illustrate a point. You can see overall that revenue is growing really well, or they call it turnover, the top line there. But you can see if we drop all the way down and I highlight it to net profit, it is down. Now, why is net profit down? Well, if we look all the way at the top of this statement, just under turnover, they have operating profit. And you can see, quite frankly, there's something going on here with their cost of goods sold. There's something going on with their costs of operating this business, their input costs, because just at an operating profit level, even though turnover or revenue is through the roof, operating profit, it's just slightly up. And so something's going on again with their cost of goods sold, which I think goes into their input costs, possibly some increased personnel costs as well, but they're not breaking that out for us right here. Although when you go all the way towards the bottom of this statement, you can see basically profit before taxation. It's basically flat, same point I just made. But after taxation, profit is actually down. And so there's something going on with the tax code as well, and something related to taxes there with Unilever. And so that is what I'm pulling away from the income statement. So not so appealing, quite frankly, as what I shared in the first slide today. And this is painting the story that, hey, nothing really goes on sale per se without some level of risk. And I'm seeing a Procter & Gamble-like moment here at Unilever, but I want to keep going. Before I do, though, if you're enjoying the video so far, don't forget to subscribe. I have new videos on the way all the time. It means the world to me. I'm up late at night on the 26th of December doing this video. I hope this is interesting to all of you. I'm a little bit tired, but I'm doing my best to get through the video for all of my friends out there in the community. I can't wait to see you in the comments, by the way. Let's keep going. As you can see on the screen, I have something else I want to share today in the third slide, and this one goes through their balance sheet, and in particular, it goes through net debt. And again, this one is from the first half of 2022 because I wasn't able to pull this information from the quarterly report, the third quarter report. But you can basically see the net debt is going up. And so net debt that they're carrying on their balance sheet, it's gone up from 25.5 billion to 27 billion in euros. And obviously that's not a great thing to see, especially as we know interest rates are higher than ever before right now. And so again, I'm sharing the story of a company that has iconic brands. I'm sharing the story here of a company that is having rapid revenue growth. But underneath this story, this is a company in transition. They're trying to refactor their business to overcome really high input costs that they're facing right now. They're trying to refactor their business to overcome the debt that's just stacking up, and hopefully they can pay off that debt over time. But let's keep going. As you can see on the screen in front of you right now, the next thing I want to share is just their outlook. At this company, at Unilever, they're basically saying they are now expecting underlying sales growth for 2022 to be above 8%. And so that's really fabulous, but the underlying volume growth, it's going to be more negative. It's going to be with more negative underlying volume growth than in the first 9 months. And so that ain't great, everyone. They're seeing volumes decline. I think the reason they're seeing volumes decline is consumers at a certain point aren't going to pay the higher prices. There's an inflection point. And quite frankly, as our economy gets worse, as there's more layoffs, as these high interest rates trickle through the economy, and as the economy starts turning, people will try to make these everyday purchases that they need last longer. Or maybe a consumer who is using the Dove Sensitive Skin downgrades to something a little bit cheaper, a little bit more affordable, or just uses a little bit less of this, uses it a little bit more sparingly to get through the day to save money. Let's keep going though. As you can see on the screen right now, what was also interesting here is it says that they have an expectation for inflation. And it basically says we expect cost pressure to carry forward into 2023. They're seeing this driven by currency devaluation, higher raw material costs, so on and so forth. And they're actually saying that they're seeing higher supplier processing costs from energy and also labor inflation as well. So a lot of bad news, and they're seeing it carry into 2023. And quite frankly, this is why for me as an investor, I don't have some kind of false hopes for Unilever. I'm buying now, and I will be buying some more soon. I'm locking in like a forward dividend yield of about 3.3%, which is pretty solid in the market right now for this particular company. It's trading at a PE of about 20. I will get into this in a minute. That's versus Procter & Gamble at a 26. I think the PE, though, at 20, it's a little bit worse than it looks. If they're able to get things back in line, I could see that PE on current price dropping maybe down to 16, 17s. I will get to those metrics later, but I'm trying to unfold a story here before I do that. Check it out on the screen in front of you right now. Another data point that they shared in their third quarter, which I thought was fun, is that turnover is growing everywhere. In APAC, in the Americas, and in Europe, although Europe is a little bit slower. And I think Europe in particular has been hit really hard with the European energy crisis. By the way, if you're from Europe, you're watching this video, please comment in the comments below if you know more about this company than I do. I don't analyze European companies all that often, although I own a few of them, but I'm excited to do that and sharpen up my skills in the video today. But you can see here that in the third quarter, one thing that was really exciting was the underlying volume growth. That's UVG. It's actually turned positive in APAC, Asia, Pacific, Africa, but it's negative everywhere else. But you can see for the 9 months that underlying volume growth, it's down everywhere. And so, but hopefully that trend that we saw in APAC continues forward. That's nice to see something positive on the screen, but you can see that the underlying pricing growth, it's positive everywhere. And so the reason they have sales growth is because the pricing growth is so strong as compared to the volume growth loss. They're basically seeing the same story in all of their markets. But again, I'm not so sure how long that can last. Let me go to something positive, though. I want to share something really positive, and that is their top line turnover. It is growing even as compared to the pre-pandemic period. So as you can see on the screen right now, they're doing a lot of comparisons, 2021 versus 2022. Of course, it's growing, quite frankly. That's a tough comparison because we're comparing more normal times to pandemic times. But I like to kind of compare things to 2019. And so what I did, because they didn't do it for me in their own reporting, is I pulled the 9 months comparable 9 months turnover from 2019. I just went on their investor relations website, pulled the information, and I was able to basically get 39 billion euros. And we know the 9 months that just ended, the turnover was 45.6 billion euros. Now we know there's 3 years that have elapsed. We've gone from 19 to 20, 20 to 21, 21 to 22. And so if I put my compound average growth rate formula here and I run my calcs, I'm basically getting a 5.1% revenue growth on average per year over the last 3 years. That is really good for a company that has a market capitalization above $100 billion, an established company with established brands. This shows me it's not just a little rebound from the pandemic lows. No, this is actually growing versus before the pandemic, which shows me that there is some secret sauce. There is some magic behind this company. When I got it started with my dividend investing, I'm called PPC Ian, but a lot of people called me CPG Ian because I bought so many CPG stocks. One of the reasons I love CPG stocks, consumer packaged goods, is they make the brands that we all need every day. But also these brands are sticky. Consumers like me, I'm not going to go for something other than the sensitive skin Dove. I got to look fresh and clean. I got to stay good. I got to stay good for the camera. And so there are other consumers like me, and I love the stickiness of these brands, the stickiness of these companies. We're seeing that with the numbers before our eyes, at least on a revenue basis, although the profit side of things these days at Unilever is looking pretty ugly, but I think they're going to get that under control. That's my personal calculated bet that I'm taking for the next 5 years, but I do think it'll take a number of years to get through that. Let's keep going. As you can see on the screen in front of you right now, I have another slide. Let's talk about the most important thing, the dividend. And so I'm doing this analysis in euros. This was a really complex business structure that's been consolidated over time. I'm looking at the euros, basically analysis that I was able to pull from their investor relations website. Now we can see on a quarterly basis, they're paying 0.4268 euros. And that hasn't really changed since Q4 of 2020. And so that shows, hey, it's not really a dividend grower at this point. And quite frankly, I usually look at a 5-year dividend compound annual average growth rate. And for 5 years, it's only 3.5%. But those 5 years include some years that have been pretty darn bad for this company. If we extrapolate just out to a 6-year period, the compound annual growth rate on the dividend is 5.9%. That's what I highlight here. And so, of course, as a US-based investor, when I convert this back into the dollar, it's all over the place. And so that's why I like to look in the native currency for this company, because the dividend is going up over time, but it doesn't always look that way to US investors because it's getting converted into US dollars, and the conversion rates have been tough because the US dollar has been so darn strong. But basically, I believe over very long periods of time that this stock offers not only a compelling starting dividend yield, but it does, and it probably will continue to offer some dividend growth. I think the dividend growth over the next few years is going to be pretty slow, if not non-existent, but I think over long periods of time, they might get back to that 5.9% dividend growth rate. And so I want to close out with 2 really important slides today. One is going to go through all the metrics. The next one is going to summarize what I uncovered from my Unilever analysis, from my check-in on this stock. Mind you, this stock, it's not a core position for me, but it's huge in my portfolio. I like to call it core plus. It's kind of didn't make that core list but it's a runner-up, if you will. And this is my largest position that I own that is based, I believe, other than BTI perhaps, but this is up there. It's one of my largest non-US stocks. And so I love this company. Let's keep going. As you can see in front of you right now, I want to compare Unilever to Procter & Gamble just to see how is this thing being valued? Well, interestingly enough, it's only 6.1% off its 52-week high, but I think that is a little misleading because you can see at the bottom, the first chart that's in all red, it is down on the 5-year period. So this thing has gone down for the last 5 years. Again, this really, really reminds me of the Procter & Gamble situation from a number of years ago, circa 2018, when I was going really heavy in that stock. Now, Procter & Gamble is also down a little more, maybe 7.7% from the high, but it's not the same story. Procter & Gamble has been doing magical things over the last 5 years. But if we zoom out and we look at both stocks over the very long-term period, if you look at the max chart all the way at the bottom, both are up and to the right over long periods of time. Unilever is just facing a few hiccups right now, and I look at it as a buying opportunity. Now, I look at the 2021 actual earnings and 2022 forward, because that's what I was able to pull for Unilever, and I did the same for Procter & Gamble. I wasn't able to get a 2023 estimate on Unilever, but anyway, on a 2021 actual, it's trading at a PE right now of 16. I think they can get back to 2021 earnings, and that's why I believe this is a value now, in my humble opinion. It is trading at a 2022 forward PE of 20, but I think that 16 is obtainable again if they get their cost inputs under control. Now, Procter & Gamble is trading at a PE of 26 right now, and so that is quite a bit higher than the 20 that Unilever is at, but theoretically, I think Unilever might be able to get it down to about a 16 PE on cost based on where they're trading, and that's why I see some value there. Now, I have a very rough analysis here. This one is based more on a US American depository receipt perspective, but I'm just looking at the dividend per quarter, the most recent one in dollar terms, US dollars, because I pay my bills in US dollars. If I multiply it by 4, I get $1.68 per year. If I divide that by the price per share, I'm getting a starting dividend yield of 3.3% roughly. Payout ratio 68.5%. Now, for taking on a little more risk with Unilever, I am getting basically almost 1 full percentage point higher than Procter & Gamble because their starting dividend yield is a 2.4%. Now, interestingly enough, their payout ratio is 62.6%. And so, again, if Unilever can just get back to where they were in 2021, which I think they probably can, at least that's the calculated bet I'm taking, I think that it's trading at a pretty reasonable discount to Procter & Gamble. Now, worth noting, the 5-year dividend in US dollar terms, it's gone nowhere, and that's because of the strong dollar. Remember, this is a dollar-centric analysis here. I've converted euros into dollars. Now, over the last 5 years, Procter & Gamble has increased the dividend by 5.8% per year on average. That was especially helped, I believe, by the last dividend increase, which was pretty darn fantastic. Now, in terms of market cap, Unilever is a $130 billion company. Procter & Gamble is way bigger at $360 billion. Would Procter & Gamble be well served here just to buy Unilever? I mean, that would be a phenomenally big and tricky and crazy acquisition, but boy, wouldn't that be so interesting given their scale. But it probably won't happen. That was just kind of fun food for thought. Let me know in the comments below what you think about Unilever, especially if you're here from Europe and you're really familiar with this company more than I am. Please share below. I've been in this company forever, as I'm about to share. Check it out on the screen right now. Just some fun thoughts on this stock. I started buying Unilever all the way back in 2012, so I've been in the company now in the stock for 10 years. And I started buying at $32.71, and so as we know, it's now at 51.07. So I'm up, which is nice. And I bought most of my shares in the 30s and 40s, but I'm happy to average up now in the 50s because I see value when I look at the metrics. They sell products that everyday consumers need. I think this is an advantageous position during tough times because some people may downgrade from using Dove soap For example, some people may use it more sparingly, but in general, these are sticky products. And I know a few years ago, a lot of people were worried, oh my goodness, is Amazon just going to white label these products and sell them cheaper? I don't think so. Amazon is facing enough challenges right now that it puts companies like Unilever and Procter & Gamble in a more advantageous position, quite frankly, as we head into some possible recessionary times. This is a strong starting yield company. I know it's crazy. People are probably going to poke fun at me in the comments for saying that 3.3% is high yield. But in the context of my portfolio right now for core plus stocks, for quality stocks, it's a higher yielder. It's no Altria. But as far as CPG goes right now, in world-class CPG, 3.3, it's all right in my book. That is a fine starting yield for me, and it can provide me some meaningful cash flow that will help me out in the long run. Now, certainly it's not going to be crazy cash flow overnight, but looking 5-10 years out, Unilever starting at a 3.3% yield with the PE metrics that I shared, I'm all right with that, but I do realize they have some challenges to overcome. Revenue growth is coming from pricing power at the expense of unit volume. The stock is on sale due to risks related to high input costs, placing pressure on their net margins. We know this. Nothing goes on sale without reason. It's gone nowhere for 5 years. This company was facing challenges before the pandemic. I think the pandemic escalated some of these challenges, but I think the pandemic also forced some change because they're reorging the whole business right now, and their CEO is actually going to be departing and retiring. And so I think they're going through their Starbucks moment, if you will, as well. And so I think they're going to reinvent themselves, and that's what I am personally investing in. Currency devaluation is another business challenge. And the stock is trading at a PE of 20 right now versus their peer Procter & Gamble at a 26. The dividend payout ratio is reasonable even on their lackluster earnings. And so I think a dividend cut is unlikely. I also don't think they're going to increase the dividend that quickly, if at all, until they get their business in order. But I look at this as a buying opportunity looking 5+ years out. Personally speaking, I'm pleased to add to this core plus CPG stock while it's in a 5-year downtrend, but I don't have high hopes for a turnaround right now. It's going to take time. It's not as strong as P&G. I like P&G more. I have a larger position in P&G. That's a core stock, not a core plus stock. That said, I'm willing to add a little Unilever here because I'm trying to boost my portfolio-wide raw dividend yield, raw dollar amount coming from dividends, because quite frankly, I was inspired by my friend Greg just to take a look at what I can do in my own world, in my own bubble, to maximize and to try to drive just a little more dividend income than I am, because there's nothing better than having dividend checks come in the mail. I love you all. If you enjoyed the video, please go ahead and click that like button. It means the world to me. Before we leave today, oh, by the way, I want to just give a shout out again. Check out the pinned comments below. I had 2 legendary interviews with the high yield investor, Greg, who just retired off of passive income. I'm going to link to those in the pinned comment again, because those 2 videos cannot get enough airplay. I think Greg outdid himself. He shared so much knowledge on the channel that I am still absorbing personally in my own way, and I have a long learning curve to learn some of the interesting techniques that he shared here on this channel. And that's why for now I'm kind of sticking with the names I know, like Unilever, as I get more up to speed on some of the concepts he was sharing here on the channel, which were pretty darn awesome. Before we leave today, in terms of a full disclosure, I'm long Unilever, ticker UL, Procter & Gamble, PG. I own Altria, ticker MO. I own BTI, ticker BTI. I am also long Starbucks, SBUX. In terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult your licensed investment advisor first. It's possible to lose money in the stock market. And investing right now, quite frankly, is a little bit more risky, I think, than ever before, given where our economy is and given, quite frankly, that stocks have gone up quite a bit. And just as a closing note, every time I've ever kind of done YouTube videos about high yield, it seems like the market has always corrected shortly thereafter. So it'll be interesting to see what happens. But if this market corrects, I'll be buying my core stocks, my core plus stocks like Unilever, and I'm looking forward to it. So we'll see if this is a precursor to the market correcting or not. But I guess I'm talking about high yield these days a little bit differently than I have in the past. I'm just buying the higher yielders and the value that I see within my own world of 51 stocks that I already own, because there's no stocks out there that I know as well as the ones I already own. All right, everyone, I hope you all had a magical Christmas, a happy holidays, and I wish you all a happy new year ahead. I will see you in the next dividend stock investing video.